I'm Brian Friedman. I'm the founder, co-founder, president, and chief investment officer of GHP Investment Advisors. Quite a bit has changed over the last 25 years. We've had some of the most extreme booms and busts in the stock market in particular since 1999 when I joined GHP Investment Advisors. Back in 1999, 1998, when I was working with my partners Bob Hochstadt and Steve Levy to start GHP Investment Advisors, the dot-com technology bubble was already well in motion. It wasn't at the peak yet, but it was clear to me that there was a bubble. And part of the reason that it was clear to me was our approach, my approach of understanding intrinsic value of the stock market and setting appropriate benchmarks, guidelines to determine fair value versus extreme valuation. I had already developed that before even starting GHP Investment Advisors. So it was clear to me, but not to the rest of the world, I don't think, that the bubble was out of hand, and it only got more out of hand from there. So starting in 1999, we did not buy at all into the technology sector. We avoided it like the plague because the valuations were extreme. And in many cases, the dot-com companies that had valuations in the billions, tens of billions, maybe even hundreds of billions for some of the biggest, despite having no profits and in many cases minimal revenues. So we avoided that sector, and in many cases we invested cash very slowly over many, many months, 24, 36 months, because we knew that this bubble was getting extreme and we wanted to avoid it as much as we possibly could. As I just mentioned, we began the company right in the middle, just prior to the peak of the dot-com bubble. And the valuation of the stock market in general was at historic highs, but not just historic highs, double, triple, quadruple in many cases, what valuations had been in previous decades. And the technology sector, and more broadly, large companies that were growing, including non-technology stocks, had valuations as we got into the late 90s that when you did the arithmetic and said, well, if a company is going to earn $1 in profit and I pay $50 for that dollar, well, it's very simple. 1 divided by 50 is 2%, meaning that's what I would expect my return to be. And if it was $100 for every dollar of profit, 1%. That's what I would expect my return to be. The arithmetic was so absurd and the arithmetic was so simple that the only way you could convince yourself that those valuations were realistic was to have a highly unrealistic view of what the economy and particularly the technology sector and this new thing called the internet could do in the coming years. I used to tell my clients back in the 90s that I believe in the internet. I believe in the future of technology, but I believe more so in arithmetic. And arithmetic was the same 2,000 or 3,000 years ago, and it will be the same 2,000 or 3,000 years from now. It doesn't matter whether you called it a dot-com or an internet stock. The arithmetic of dollars and cents, of valuation, the value you paid for a company relative to $1 of earnings, that will always and forever be the same. And that's the core of our investment philosophy. Well, it's interesting. I have just mentioned that we survived the dot-com bubble. In fact, we thrived during the dot-com bubble because we did not participate in the dot-com bubble. And at the core is our benchmarking philosophy, where we say there are rational and reasonable valuations that we are willing to pay but we are not willing to pay more, and we are not willing to believe absurd things, even if the entire world believes in those absurd things. And one of the things that happened when the dot-com bubble burst, you have to remember the backdrop. Remember that firstly, the Federal Reserve raised interest rates in the late 90s and the early 2000s, in part to pop the dot-com bubble. Well, that had the effect of creating a great deal of value outside of the stock market in everything that was sensitive to interest rates, particularly real estate. And in our little corner of the world, you could see that, for example, in the real estate investment trusts. These are stocks that own shopping malls, office buildings, apartment buildings, etc. The yields, the returns that you could earn, cash returns, not future speculative gains in price. I'm talking about cash yields, were on the order of 8, 9, 10%, sometimes more, for high quality real estate. At the same time, residential real estate also was quite inexpensive, particularly relative to income. So in a sense, I would argue the collapse of the dot-com bubble begat the real estate bubble. And when the Federal Reserve began to reduce interest rates in the early 2000s, it of course sparked a surge in the real estate markets. And that was true in residential real estate, that was true in commercial real estate, and it was also true for the financial institutions that financed both of those, particularly residential real estate. Well, I had mentioned that we have what we call our benchmarking philosophy. What we do is we say, well, what is an appropriate metric? What is an appropriate valuation for a stock or a company or an industry or an entire asset class? And we say, okay, if a reasonable value is X, we're not willing to pay more than X. And we do that not just for the stock market as a whole. We do it for different subsectors within the stock market, asset classes they're called. But we also do it for real estate. We do it for bonds. We try to do it for all financial assets so that we have this global view of what is reasonable and what is not reasonable. So we have that. We also do it for other metrics, and one of those metrics is debt. So now coming back to the financial crisis. Well, in the years leading up to the financial crisis in 2008, 2009, our benchmarks were increasingly violated. One, valuation. Well, real estate prices were starting to get well above our indicators, our benchmarks of reasonable. But perhaps more importantly, in the financial sector, amongst some of the financial institutions and banks, our metrics, our benchmarks regarding debt were starting to get violated in a major way. And how do we know this? Well, we just took a look, for example, at the brokerage firms. Lehman Brothers, Bear Stearns, some of the banks. If you looked at the amount of leverage, they call it, the amount of debt, the relationship between their debt and their equity was the highest it had ever been. You could also inverse that relationship and say, okay, take Lehman Brothers, who failed ultimately in 2008. If you started to look at the total amount of equity, how much money the owners had invested in the company as a percentage of total assets, it was less than 2%, meaning that all the assets, all the loans that they had participated in securitization, they only needed a little more than 2% of those to go bad to bring down the entire company. Well, that's hubris. That is way beyond what we consider reasonable. Typically in the financial sector, we want to see closer to 10%, more sometimes, depending on the nature of the lending involved or the riskiness of the assets. As a result, our benchmarks were violated in a very significant way. Not to mention the degree of leverage that homeowners were using to purchase homes and the degree of leverage that many of the commercial real estate buyers were using, meaning debt had become pervasive throughout the real estate sector and the financial sector. We realized that there was a problem. What we did not realize was that there was going to be a financial crisis. We don't try to predict the future in that regard. But what we did know is that there was tremendous risk in all the stocks that violated our metrics of valuation and debt. And we avoided those once again like the plague. Our approach, once again, was to avoid things that could result in catastrophic loss, not to try to predict what the future holds, because we don't know. Nobody knows. So as a result, when the financial crisis occurred, also to our surprise, we were prepared. And what we've said then and what we say now is the best way to prepare for a hurricane is to have built a strong house in the first place. That's our approach. I'm proud of many things. I'm proud that we survived. I'm proud that we navigated incredibly choppy waters. As I mentioned in one of my other answers, we've had some of the most extreme booms and busts in financial history in the last 25 years. Just to put it in perspective, we had 2 stock market crashes since 1999 that were 50% or greater. The only other time in history that there was a 50% or greater decline in the stock market was 1929 to 1932, the Great Depression. That's it. Then, and the 2 that we lived through during the 25 years that we've been in business. So I'm very proud that we survived and thrived, ultimately. I'm proud that because we survived and thrived, our clients who have been with us during all these years have done very well. They've met their objectives, and we've helped them meet their objectives without exorbitant risks. I'm proud that many of my partners and the people that have worked with me have been here now for 2 decades, and that we have created opportunity for a wide variety of people, and that those opportunities continue to grow, and we continue to grow. I look forward to the coming 25 years. I'm hopeful that we will not experience 2 more booms and busts on the scale of the dot-com bubble or the great financial crisis. But if we do, we're ready. We're prepared. Our philosophy is battle-tested. Our team is battle-tested. We understand how to operate and what to do during extreme circumstances and how to prepare for those extreme circumstances without trying to guess what the future may bring. We are prepared, we're ready, and I'm very proud that we've created a resilient, well-prepared, very grounded team that has been with us now for many, many years.